Burr Cash Flow Live. And today we are talking about we should be praying for high interest rates. Now, if you're somebody that is investing in real estate, you should be wondering what is wrong with you, Andrew? Why are you praying for high interest rates? As real estate investors, shouldn't we be praying about, hey, God, give me low interest rates? Real estate, God, give me low interest rates. Well, here's why I'm saying why we should be praying and why we should be actually enthusiastic about the rates going up. So before we get into it, remember today we're doing the drawing for the winner of the Burr Cash Flow Investors Contest, and that is because you referred a bunch of people for your friends, for family, to join Burr Cash Flow Investors. So we're going to have that pick later here in a few minutes at the end of the broadcast today. And we're going to announce the next prize, which is going to be the next time. So today we're going to pick a winner, and then we're going to announce the prize for the next time. So if you have any friends, family, colleagues, or other real estate investors, or wannabe real estate investors, you can always refer them to Burr Cash Flow, become a part of the community, and let's learn and let's grow together. Again, that's burrcashflowinvestors.com. Everybody that showed up for the 3-day, we really hope you enjoyed the 3-day, got something out of it, and your time that was spent with us was well worth it. It's always great seeing everybody from Mastery, a lot of friends, a lot of people, and so we're up and pumped and getting started. And congratulations to everybody that's a part of the new Mastery. This is an amazing journey, and our job is to inspire you and hopefully be able to help you transform your life and take it to the next level when it comes to you financially doing better for you. Having said that, let's get started. So today we're specifically talking about why should we be praying? Why should we be actually positive, happy for high interest rates? Now, I know if you look at a lot of the podcasts, if you look at a lot of the agents, you talk to anybody that really, to me, is not a professional real estate investor, right? They're going to fall in a couple of different categories. People who basically always want low interest rates. If you're a loan officer, if you're a mortgage broker, if you're in the title business, if you do any of those types of things, right? Any hiccup in the market, if the rates go up, something happens, right, is terrible for you. Why? Because the number of sales drop. When the number of sales drop, guess what happens? What happens is your number of sales go down. You have to actually be very diligent. You have to work harder. When everything is good, things are going up, guess what happens? You do a lot of more sales because everything is really hot. Then everybody's complaining last 2 or 3 years, oh my God, I can't find a property for my clients to buy. Now, as a real estate investor, so let's understand what is the category of real estate investor and who should be happy and who should not be happy, right? And this is not about positive thinking. This is not about praying on, oh my God, something bad is happening, so I'm happy. There's a logic behind what I'm going to suggest to you. So here it goes. So what are the type of real estate investors that are investing in the market? So there are some real estate investors that are, I would call them amateur, and people who are investing because they feel buying a property is a good thing because in general, over a period of time, the real estate market goes up, or they can create a little bit of a cash flow, or they can buy real estate and then there's depreciation and other advantages. A father says to his son, hey, you're going to college, and in the town that you're going, we're going to go ahead and buy a property. 2 or 3 roommates live together, and then 3 or 4 years from now, we're going to sell it, right? That's that thing. The other investor is, well, I need to park some money somewhere, and I'm going to go ahead and invest in real estate. So that's one category of people. Now, these category of people mainly are relying on one thing, which is they're relying on appreciation on the property. Nothing wrong with that, but that's not how professional investors should be investing, in my opinion. And again, if that's how you do it, that you're basically trying to time the market, I think that is a very foolish way of investing. I don't think that's a wise way of investing. You're basically trying to get lucky so that you're going to time the market. Now, if you're a long-term investor, your numbers are still going to be okay because in the long term, right, we're talking about 10, 15, 20, 30-year period, that sort of an investment horizon, then you're going to come out okay. But if you're a short-term investor and you're trying to time the market, I think it's a very bad idea in general. Now, has it worked for people? Absolutely. right? All the way from 2012, all the way through till 2021, 2022, in fact, early part of 2022, it worked. It was fabulous. If you buy a property and you sat on it, you rented it out, I mean, you got some fabulous returns. So no question about that, that it works. It's just that, to me, is not investing. That's saying, hey, listen, I put some money in real estate. I got lucky as the market went up and I held on to it. And over time, I made money. Nothing wrong in it, but that's not investing. So what's the second category? Well, second category of people are those people who are doing flips, or people who are buying property and they say, well, I'm buying property only for cash flow. So if they're basically doing flips and they're hoping to buy the property and then they turn around and sell it, guess what happens to them in today's market? Well, hopefully, and this is my hope, that if you bought the property in the last 4, 5, 6 months, hopefully you took into account that on the back end, the market is going to be weak. And so hopefully you bought the property at enough of a discount. So if you bought the property at enough of a discount, based on that, on the back end, I'm going to sell the property on the lower end of the scale, then you're going to be totally fine. Now, you may not make as much money that you would have made, say, a year ago or so, because the prices were going absolutely bonkers. Right? You could make a mistake and still get away with it because the property price was going straight through the roof. So at that time, you may have done very well. Today, if you're doing big properties, right? Bigger properties in general are the properties that are having a hard time to sell. Properties who are on the very, very cheap side, meaning where people can barely qualify, those properties, property extremes, are where the market is affected the most. Generally, mid-category properties are still doing okay. So the difference today is this, that even though the interest rates have gone up, relatively still the inventory is low. So if you're in B plus markets, A markets, and you're in the basically the 60 percentile of the price range of any town, generally those properties are still selling. So places like Austin, places like San Fran, places like Seattle, places that have been just ridiculously very hot, those are the places where we're expecting the numbers to come down. So now, there's a third category of people. Third category of people, I consider people like us, people who are buying properties for 2 or 3 different reasons. Number one, if they're buying a property to do a flip, they're taking into account what the numbers are. I was actually told, Joe, I'm not going to use the screen, but I am. So my apologies, Joe. If you don't mind, if you can flip that screen here, and I think I can demonstrate that a little bit better with an example. So let's just say last year, before the interest rates went up, you had an interest rate somewhere around 3.2, somewhere around 3.5%. What does that mean? So when the interest rate is 3.2, 3.5%, people will say, well, you know, I can pay basically X amount of dollars for the property, because people were not concerned about the price. What people were concerned about is, hey, what is my payment? Let's just say their payment is $1,800, right? And so I want to kind of show you guys the example of this. So let me put some actual numbers here, and I'll show you guys what the difference is in terms of the numbers, right? So let's just say they're buying a $300,000 property, and they are going to put down 3.5%. Their rate is 3.2. And their taxes yearly are $6,500. So I'm using some numbers here in the Illinois, Chicagoland area. Florida, they would be a little different. So their taxes are about $6,500. Their insurance is about $800, and they're buying a $300,000 property. Let's just say they're putting $300,000 down. So what does that mean? Their payment on the property actually is $1,860. So let me put $1,860 for a $300,000 house, 3.5% down. And let's just say they have $200 PMI, right? So their payment basically is going to look something like this. It's going to be $2,060 is what their payment is going to be. So now they say whenever people are basically qualifying for properties, most people that are going to be in that FHA category, or even if they're putting 10, 12% down, what they say is, hey, I can afford a $2,000, payment, or in this case, $2,060 in payment. Now let's look at where we are today. Right? The rates today are somewhere around, I'm just going to keep it even at 6%. Now watch what happens, right? If the rates today are at 6%, what happens is their payments are at $2,344. And if I add, now PMI, I'm approximately the PMI, I might be a little bit off, but approximately, now suddenly, what is their payment? Their payment is $2,544. So the payment is up by almost $500. And we know this about Americans as a group, that most Americans as a group, we buy to the hilt, right? We're not saying, oh my God, I can afford 4,000. But I'm going to buy only 4,000 4,000, I can afford 4,000 in terms of a home payment, but I'm only going to buy a home where I'm going to pay 2,000 or 2,500 on. Now, if your budget is $4,000 or $5,000, right, then most Americans, I'm not talking about all, but most Americans are not buying a home way under their budget. What do most Americans do? Most Americans buy at the top of it. And most people say, well, Andrew, why not? Don't I deserve a nice house? Doesn't my family deserve a nice big house? Absolutely it does. But you have to make that decision whether that is you. We know the average person will not be able to afford to go up that much in terms of their payment. So what happens? Well, that happens to a lot of people in a given market. Then what is that going to do? The only thing that can happen is either people are going to sit on the sidelines, or it's going to drive the price for homes, it's going to drive it down. Now, who's it bad for? It's bad for the flipper that is doing that one flip and is hoping to make a lot of money from it. Or it's bad for the flipper that bought the property and doesn't have a lot of margin in the flip. Now, if I have a flip, I'll give you guys an example. Right now, I have a flip going on in South Holland. I bought it for $117, and after repairs, after all the costs, was bought at auction, so I'm going to have to pay 1 year worth of taxes. All of that said and done, I'm going to be in that property, including purchase, rehab, everything, somewhere around $50,000 plus I add the selling expense plus the carrying cost. So from 117, so let's just make it 120 plus 50, that puts me at 70 plus all the other costs that add up. So I'm in the deal for 200. I have that particular property right now as we speak on the market for $275,000. Now, if my all-in cost, which is your purchase, your rehab, your carrying cost, your money cost, your cost of selling, your cost of finance, right? All of those costs, your taxes that are owed. If all of that cost, my cost is at 200, right? And I'm trying to sell the property for 275. Well, what happens if I sell it for 270? Well, I've had to take, basically, I'm going to make 5,000 less. Well, what about if I have to sell it for 260? Well, now instead of making $75,000, I'm making 60. Well, what if I have to sell the property 250? Right? Now I'm only making $50,000. Now, do I like only making $50,000? And I'm saying only because my expectation are that property is reasonably, I need to make $55,000 to $57,000. That justifies that particular sale on that property, in my opinion, for me. Now, you might say, well, but I would be happy with 30. Well, that's fine. Then you would have paid more than I would pay for the property. But that's just the difference between you and I. Now, if you have a low margin, right, and then the market shifts on you, what's going to happen? Instead of making 30, you may only make 20, or you may only make 10, or if the price has come down that far, you may not make anything or lose money. Now, I have more room to go in that particular property. Hence, I can basically reduce the price down so that I can undercut you in terms of the market in that case. Now, do I like it? No, of course, you want to be able to make as much money as possible. Now, I wish I could keep that property. Unfortunately, in South Holland, there's more than 10% properties on that street that are, I guess they say they have renters, so they're not going to let me keep it as a rental. Otherwise, I would have kept the property. I could get super high rents. Why would I ever want to sell that property? But the case is what it is. So if I was a flipper with low margins, I would get hurt. If I'm a real estate agent in South Holland that's trying to sell properties and the interest rates are super high, guess what? The demand is low. I don't like it. If I'm a loan officer, there's not as many refis going on. I don't like it, right? So then on the other side of it, who am I as an investor? Why do I like it? Right? See, the reason why I like high interest rates is this, because I'm not in the category of a desperate flipper. I'm not in the category of a person who's a real estate agent. I'm not in the category of a person who's a loan officer. I'm in the category of I'm a buyer. And I'm a buyer of assets when they get beat down. And I will buy more properties when properties are beat down, when the mood of the market is sour, meaning when basically if the market is bearish, they're like, oh my God, it's terrible. Oh my God, everything is coming to an end. I started in that market 2008 when everybody was running for the hills. That's when I started. So this sort of a thing is like, do I want the interest rates to be absolutely terrible? Of course not, right? Any reasonable human being will not want the interest rates to be terrible, right? But the rates where we're at, this is something we can work with all day long, somewhere around where the numbers are, because what has happened is the rental rate in the meantime has become higher and higher and higher, that people are paying more and more and more on the rents. Now, what's happening is there's a downward pressure in terms of the prices that other competitors of mine are willing to pay. So what happens when the market turns? See, when the market turns, this is something we have talked about before. There are two types of market. There is a retail market, and then there is a wholesale market. What does that mean? Wholesale meaning that, and I'm not talking about wholesaling right now, I'm talking about there is a investor market, meaning the prices somebody like me would pay for. So the deal is, how much is the discount delta between the retail price versus the prices in general I'm willing to pay? And when does this go down? See, this delta goes down and gets closer and closer as more and more investors jump in. The competition goes up. But guess what happens as the market cools? The delta between the retail prices and this starts going up, meaning I can find more and more and more properties for bigger discounts, right? When I say let's pray for interest rates to hold, why? Because there is too much of a money supply in the market. See, back in 2008, 9, 10, 11, 12, 13, 14, right? The money supply in the market was low, right? There was not enough capital. Today, what are they trying to do? They're trying to suck the money supply out by raising the interest rates. We are in a different market. At that time, there was a lot of inventory on the market, but the banks were not giving out money. There was no hedge fund in the market that would give you money for your deals. Today, we are in a different place. We're in a place where there's actually still a lot of money. Yes, it's a little bit more expensive than it was. A commercial loan a year and a half ago, I could do a commercial loan for about 5.2. Today, that same commercial loan is costing me about 7.7, right? Do I like that? Of course not. But guess what I like? I like that the net profits are up, meaning the net profit on a rental property is up, because what's happening is I'm finding more and more deals. So if you're a professional real estate investor, right, this is a market that you should really go to work in. See, when everybody else is buying, take a vacation. When most people are running for the hills, that's when you need to be jumping in. So that's really, really important to understand that it's not, guys, the market, the rates, those things we can't do anything about. The only thing we can do something about is what we do with that particular market. What do we make of it rather than running for the hills? So if you're a real pro real estate investor, today is the time to drill down and really look for deals, because guess what's happening? Sellers are desperate, especially when properties need work. And because they're desperate and their properties need work, hence you and I can make some really good deals. So hopefully this makes some sense to you. I hope you understood what I was saying by pray for the interest rates to hold, pay for high interest rates. Nobody's saying that you want, 12, 13, 14% interest rates. But yet we have to understand that as something turns in a market, what happens is that will work in your favor if you are a professional real estate investor that really understands how the interest rates versus the price really takes place, so you can buy properties at a lower cost. Having said that, we are supposed to announce the winner. So I think they have it picked out. So let me make sure. Lori. Okay, so who is the winner for the giveaway? So this is a cruise for two. So whoever wins, right, is going on a cruise for two on our dime. And this is a person that obviously sent a whole bunch of people to be members of Burr Cash Flow Investors. So who is that person? Its last name is Isa, ISA, and the first name is Amal. Amal Isa is the winner for the cruise giveaway for two. So Miss Amal and your husband, you guys are going on a cruise. So congratulations. We're super thrilled for you. Contact Miss Jennifer, and she will figure out how to get the hot little tickets in your hands. Having said that, for everybody that joined us, I hope you enjoyed. Next time, we're going to announce the next giveaway that we're going to do. So we're going to try to find something fun and exciting. This time, it's a cruise for two. And if you see Miss Amal, congratulate her and her husband. Thanks a bunch, guys, and we'll talk to you soon.